Americans were supposed to face a tax tsunami in 2026. More than $4 trillion in tax increases were scheduled to take effect. Higher tax rates, smaller deductions, a financial squeeze that would ripple through every household in America. And then, something unexpected happened. Congress didn't let it happen. But here's the problem. They solved one crisis by creating another. In July 2025, the One Big Beautiful Bill Act made most of the 2017 Tax Cuts and Jobs Act permanent. The dreaded tax cliff appeared to vanish. Your tax rates stayed low. Your standard deduction doubled. The danger seemed to pass. But seasoned wealth builders know a dangerous truth. The easiest threat to spot is never the one that destroys you. The 2026 tax system isn't a cliff. It's a series of hidden trapdoors, and every single door is moving. If you don't understand which doors are closing, how you'll be forced through them, and when they lock permanently, you're about to make a six-figure mistake. Most Americans believe 2026 brought stability. Congress fixed the problem. Taxes are settled. This is the myth, and it's expensive. The reality is different. Yes, your individual income tax rates are now permanent at 10%, 12%, 22%, 24%, 32%, 35%, and 37%. That's good. Yes, your standard deduction is locked in at $16,100 for single filers and $32,200 for married couples. That's also good. But permanence isn't everywhere. While Congress made individual rates permanent, they created two separate tax futures. One path for most Americans, one path for high-income earners and those in high-tax states. And the rules governing these paths are about to change again. Here's the math that matters. The state and local tax, or SALT, deduction limit was raised to approximately $40,400 in 2026, up from the previous $10,000 cap. This helps higher-income families in California, New York, and New Jersey recover tax deductions they'd lost. But there's a hidden timer ticking and a hidden income trap. That $40,400 SALT cap expires in 2030. In just 4 years, it reverts back to $10,000. Let me run the actual math. A family earning $500,000 per year in a high-tax state like California might pay $45,000 to $55,000 in combined state and local taxes annually. Income taxes plus property taxes combined. From 2026 to 2029, they can deduct $40,400. Starting in 2030, that cap drops to $10,000. They lose the ability to deduct the additional $30,400. If they're in the 37% federal tax bracket, that lost deduction costs them approximately $11,250 per year in additional federal taxes. This is a real wealth impact, and it's now just 4 years away. But here's the hidden qualifier that changes everything. If that same family earns slightly more, the rules change dramatically. For every dollar of income above $5,000 in 2026, the SALT deduction cap is reduced by 30 cents. This means a household earning $600,000 gets barely any benefit from the increased cap. The wealthiest taxpayers, ironically, barely benefit from this law. The real winners are upper-middle-income earners in high-tax states earning between $300,000 and $500,000 annually. And because the cap expires in 2030, not in earlier years, most wealth builders aren't preparing for it now. They're making decisions today that will lock them into massive losses 4 years from now. Now, the salt crisis affects high-income households and professionals. But there's another group facing a completely different 2026 challenge: business owners. And their clock is ticking even faster. If you own a business, a rental property, or any asset that produces income, the 2026 tax rules contain good news and a hidden question. It's called bonus depreciation. And the story just flipped. From 2017 to 2022, business owners could immediately deduct 100% of the cost of qualifying equipment and property purchases in the year they bought them. This meant that a $500,000 equipment purchase generated a $500,000 deduction in year one, potentially saving $150,000 or more in taxes. Then the benefits started disappearing. By 2025, bonus depreciation had been reduced to just 40%. The trajectory looked clear. It would hit zero by 2027. But in early 2026, Congress reversed course. The One Big Beautiful Bill Act restored 100% bonus depreciation permanently. For business owners, this is a dramatic reversal. A $500,000 equipment purchase made after January 19, 2025, generates a full $500,000 deduction in year one again. No more waiting. No more depreciation schedules. The immediate write-off is restored. But here's the question every business owner should ask. Will this permanence last? Congress could change these rules tomorrow. The permanence of today's law is only as secure as the next administration's priorities. Smart business owners are asking themselves this question right now. Should I accelerate my capital spending to use the bonus depreciation while it exists? Or have I already missed the window? The answer depends on your business strategy, not just tax optimization. There's another permanent change that most entrepreneurs miss. The Section 199A Qualified Business Income Deduction, often called the QBI deduction, is now permanent. This allows certain business owners to deduct 20% of their qualified business income from their personal tax returns. For a business generating $500,000 in income, this can mean a $100,000 deduction. But permanence comes with a catch. The QBI deduction phases out above certain income thresholds, and those thresholds are expanding. The phase-out range for married filing jointly filers is being expanded. This means that as your business grows, your ability to claim the full QBI deduction starts to disappear. The trap is this. Entrepreneurs focusing on growing revenue without understanding where their QBI deduction evaporates could end up with higher effective tax rates as they scale. These business-level tax planning decisions matter now because they affect how much wealth you'll have to transfer to your heirs. And that brings us to the third hidden clock, the wealth transfer window that Congress just expanded, but only temporarily. In 2026, the estate tax exemption increased to $15 million per person. That's $30 million for a married couple. This means you can transfer up to $15 million in assets to your heirs completely free of federal estate tax. For most people, this seems enormous and permanent, and under current law, it is. The One Big Beautiful Bill Act made this exemption permanent and will adjust it annually for inflation starting in 2027. The crisis that was supposed to happen in 2026 has been prevented. But here's what's worth understanding. Congress retains the authority to change any tax law. Future administrations may choose to reduce exemptions. Historically, exemptions have been adjusted multiple times. For wealthy families with $10 million, $20 million, or $50 million in assets, this creates a one-time gifting window. Use the exemption now while it exists at $15 million. Don't gamble that it stays. Most family offices and serious wealth builders are strategically gifting right now to lock in the exemption at its current level. There's one more rule change arriving in 2026 that impacts wealth builders differently: digital asset reporting. Starting in 2026, if you hold Bitcoin, Ethereum, or any other cryptocurrency, centralized exchanges must report your transactions using Form 1099-DA. For 2025 activity, brokers report sales proceeds. Starting with 2026 transactions, they'll report your full cost basis. This isn't automatic auditing, it's increased transparency. The IRS can now match your reported gains against broker-reported data. Mistakes or omissions become instantly visible. The compliance risk isn't a dragnet audit. It's a higher likelihood that discrepancies between your tax return and broker reports trigger examination. Investors who've been casually buying and selling crypto, moving between exchanges, and not tracking cost basis meticulously are now facing significant reporting requirements. Mistakes here can trigger penalties, audits, and years of backfiling. The 2026 tax cliff for digital asset investors isn't higher rates. It's higher compliance costs and higher audit risk. So what do smart wealth builders do? They don't panic about a cliff that didn't happen, but they do prepare for the cliffs that are hidden. Here's the framework. First, run the numbers for 2030. Model your SALT deduction, your income, and your state taxes when the $40,400 cap reverts to $10,000. If you'll be affected, you have 4 years to restructure your tax domicile, your income sources, or your deduction strategy. Waiting until 2030 is expensive. Deciding now is free. Second, if you own a business, evaluate your capital spending schedule through 2026. Is there equipment, property, or assets you've been planning to purchase? The 100% bonus depreciation window is open now. This is the moment to evaluate strategic purchases, not because the tax law forces you, but because your business strategy makes sense. But only if the business justification exists. Never let tax tail wag the business dog. Third, review your estate plan with current 2026 exemptions in mind. If you have $10 million or more in assets, the $15 million exemption is a one-time gift to you from Congress. Use it now or risk waiting and watching the exemption landscape change. Most high net worth families are strategically gifting right now to lock in the exemption. The 2026 tax system isn't actually a cliff. It's a series of doors. Some doors are permanently locked at favorable rates. Some doors are closing in 2030. Some doors change shape in ways that hurt careless investors but reward prepared ones. The difference between getting crushed by the 2026 tax rules and mastering them is this: understanding which doors are moving when they close and where you need to be standing when they do. The wealth IQ path forward is clarity. Know your numbers. Model your future. Decide your tax strategy now, not later, not next quarter, today. Because the decisions you make in 2026 about your taxes, your business, and your estate will echo through 2030 and beyond. The wealthy don't react to tax cliffs. They see them coming from miles away.